I just wanted to put out a little video regarding the flash crash that we had yesterday. Just a couple of the causes, what's going on, what's going to happen, well, at least what could potentially happen. Are we going to bounce? Are we going to continue down? And that sort of thing. But to start off, I just wanted to draw your eyes to my portfolio. So obviously we've taken quite a hit in the last few days. Initially, we had the beginning of a sell-off on Friday, which I wasn't too concerned with. I did expect that things regarding recession woes would calm down given the services data that was coming. As long as it didn't come in bad, I thought that would ease things a little bit. But yeah, let's crack on. Let's start off then by looking at the Fed. So we had the pause in the interest rates, and then we had the commentary, and it was fairly dovish, so not too much exciting happening on that day. But then we had the non-farm payrolls coming in, and there's a lot less jobs being added to the market than was the expectation. The expectation was for 175 to 190. We've come in with 114. Now that's not super. Wait, it's pretty bad, but it's not like super worrying. The worrying factor here is the huge revisions that this data has been having as well. So if we base this on the expectation that we're also going to get revised down, that gets us into really concerning territory, given the really aggressive trend here. We did get this April read. I commented on this on the weekly macro wrap up that this was very, very worrying. I thought initially it could be a red herring and may sort of ease my concerns a little bit, but given that that got revised down as well, and then we've continued to drop and drop, that's been a very major concern for the market on recession fears. So we had a little bit of panic coming from that. And as well on the Friday, we had the unemployment rate taking quite a large jump up to 4.3%. Now, that's not it's bad really because that the Fed wanted to keep it under 4%, and that's not happening now. So this is probably actually much higher than this, given the number massaging that normally happens, which is probably also true of payrolls and such. But all in all, that wasn't terrible. When we initially started to sell off from this, I thought that the data coming this week would help alleviate some of that worry, which for the most part is true if we have a look at the data we got yesterday. If I can find it. We had the S&P global readings coming in slightly below forecast, but nothing majorly so. And still, if we look, you can see it quickly here, they're still looking pretty healthy overall when compared historically, at least recently anyway. But then we also had the services data that is used for that, and the numbers are pretty good. Nothing too alarming here. Most things higher than forecast. So overall, this was really good. It's really going to support stabilizing things and ease off recession fears a little bit. I think if we do get a recession here, I mean, I'm pretty sure the consumer's in recession already, and we're likely to get some sort of recession, although I think it's going to be really short and shallow. I'm not expecting anything too bad, mainly because the US has got so many levers they can turn. They can really pump liquidity in, which they're starting to do. M2 money supplies coming up. The Fed can ease their runoff. The Fed can lower rates quite substantially. So there's a lot of ways in which they can really support the economy that they haven't touched yet. So I wouldn't be too concerned about a really nasty recession right now. So that kind of sustains that issue a little bit. Last week was also a very critical earnings week. We had a lot of the big companies putting out their numbers, and for the most part, they were okay. Nothing groundbreaking, but I think the market wanted groundbreaking, and it needed groundbreaking earnings to be able to justify some of the multiples it was given to the companies, especially a lot of the tech companies. However, we have been pulling back quite a lot during this earnings week and then into it. So I think actually some of the companies are starting to get fairly reasonably priced. So that covers us up until the weekend, and then we've got the weekend shenanigans, all the news coming out about Iran, Buffett selling chunks of his stocks, mainly Apple, I think it was. And then obviously we've hit on with this Japan trade unwind, which is quite interesting. It's caused a lot of panic selling for the rest of the economy. It's really been a bit of doo-doo in the fan kind of situation. So I'm going to try and keep this simple. Please let me know if I'm getting too confusing here. What happens here with the carry trade is traders borrow money in the currency. For the most part, this is going to be the yen at the moment. And whilst that's a low interest rate, that's all well and good. And then they convert to another currency, which in this case is the dollar. What they're doing then is they're investing that cheap money into better yielding assets. For the most part, that's going to be bonds, but it can include stocks and stuff like that. The theory is great, but in practice, when things go wrong, they go wrong fast, and that's what we're seeing here. So when the yen yield goes down and the new currency also goes down, and then also, which seems to have been the trigger in this situation, the Japanese fellas put the interest rate up. That's really caused a cascading effect here. That's been a triple whammy to this yen carry trade. So as a rough example, say somebody borrows $1 billion of yen, 1 billion yen, not dollars, sorry. Say that's at like a 1% cost to them. They convert that to the dollar, so now they've got $6.9 million, something along those lines, and then they put that in bonds, and they're getting 5% on those bonds, which is all fantastic. And they get about quarter 276 million, I think I saw this was. So that's about 4% risk-free return on that. Now, what's happened is the USD yen exchange rate can go down. You still owe a billion, plus the extra from the conversion, so that's a good old 450k loss there. You can also get bond sell-off, so you lose some value there. Then you can also be affected by the interest rates in the local currency of wherever this is coming from, which will be a triple whammy. But the main concern here with Japan is they are the largest holder of US bonds. Now, as a result of this panic, the algos will be triggering and selling as well, and it just turns into a vicious cycle. Retail selling, institutions selling, everyone just dumped a bunch of stuff. So we had the fourth largest hedge fund, Capula Management, buying Bitcoin. So they're trying to take advantage of things. So that's nice to see. This one was interesting though, that the fear index was higher on this event than it was for the US banking crisis. That tells you everything you need to know about how risky this unwinding is. Very risky. I don't know if this is the end of it, if contagion is going to get worse. We don't know what's going to happen with the bonds. Are they going to start dumping them? Are they going to dump some treasuries? Is this going to spread even further? What I do know is I'm definitely paying close attention to what's happening there now. This wasn't even on my radar, and I feel quite bad saying that, but I was mainly focused on US and China. But this just goes to show even people that have been in the market a long time are learning new things all the time. This also impacts a lot on the Forex side of the markets, which I don't claim to know remotely enough about. So I'm going to have to find some time to learn more about that as well. So the macro picture is getting really, really broad at the moment, but I'm trying to break it down as much as I can and make it easily digestible. Hopefully, I've made you a bit more confident in understanding what's happening out there. But even I'm going to have to learn some more things now. So I'm going to go away and do that, and hopefully be a better investor for it. So overall, it's just people got way too over leveraged. Yes, this is on an institutional level, but we can see a lot of retail getting blown up today as well, where they've just got overly confident and they've leveraged up to the eyeballs with money they don't have. So when the margin callers come, they've just blown up. Market does look like it's bouncing back decently today, though. So I'm very hesitant about this, if it's going to hold or not, or if we're going to go down. So it's definitely something to keep an eye on. But don't be shocked if we get another bleed out. This could just be a bit of a dead cat bounce. It's really hard to tell how far the contagion is, and we need to see what Japan does next.